So welcome back to our videos, Conversations with an Accountant. This is Sagar Shah. My name is Joseph Scotti, and we're with Shah & Sons going over probably one of the most prominent parts of our presidential campaign so far, which is the big, beautiful bill. How is it incorporated in our everyday lives? What are things that are going to impact specifically what we're going to be doing day to day? And there are a lot of stuff that goes on throughout this tax bill, right? Things like healthcare and the Medicare updates, Medicare and Social Security, things like the energy and the environment provisions that maybe some of the things are that they've changed, tax mechanics on how Social Security and some of those opportunities work, AI and the federal state balance. So there's a lot of pieces that are really incorporated in this bill. And obviously when they say big, beautiful bill, the big part is accentuated because it is very large and there's a lot of components to it. What we're going to be focusing on predominantly today is the tax side of things.
So it is one big bill. I do agree with that. I don't know how beautiful it is. I think that depends on you personally and the situation you're in. You know, something that is like a theme that we keep repeating over and over is anything, any law, any bill, it's really relevant to your personal and particular situation. It's useless for someone who is not in real estate, has no interest in real estate, to then sit there and listen to a video discussing all the intricacies of the tax bill and how it affects real estate. Right? Similarly, if you make less than $500,000 and you don't think you will ever make more than $500,000, why would you sit here and listen to
the whole first quarter of the video, right?
We're just talking about people who make more than a certain amount of money. So this video in general is more of a primer and just educationally kind of trying to lay out the foundation of where this bill is and what it does versus trying to teach you every little nook and cranny of it, which is not possible in one video. I think the last count was like over 950 pages of the bill. So I'm gonna lay out the most important things. And what we want to do is we want to hit high income individuals first. We're going to talk about middle and low income individuals next. We're going to talk about small and medium sized businesses and all the different changes and tax credits that are available for that. I'm sure if you've been following along, this is the biggest portion of the current administration's agenda. This is actually the crux of what I've been waiting for because it changes the entire landscape and it changes the way people go about conducting business and personally how you get paid.
So from a high income W-2 employees, right, let's dive into probably the most prominent part of the bill, right? The SALT cap reprieve and then the cliff and how that works. So why don't we dive into that as the first part for high income. So high income W-2 employees would be anybody pulling in what, $500,000 or more, we'd say?
Yeah, so we're using $500,000 for our purposes because that's where the SALT cap limit kind of splits.
Yeah, so let's talk about that.
That I think should be the benchmark for what's considered high or not high. Not as like a judgment, but as like a based on what these new laws are breaking down. So what is the SALT cap? SALT stands for state and local taxes, right? This started in 2018. Prior to 2018, so in the Obama era tax rules, if you paid a lot of state income tax or a lot of property taxes, you would be able to deduct every dollar of those income taxes plus property taxes against your federal income, and you would get a credit for that.
Right.
So you paid $100,000 in property tax and state income taxes because you're a high earner, you would get about a $37,000 tax break on your federal income taxes.
Previously.
Okay. Starting in 2018, that went away. The cap became $10,000. We had plenty of clients who, let's say they're making $250,000 a year and they worked in New York City.
They're hitting that easily.
Yeah, they're probably paying close to $20,000 just in income tax. Then they're paying whatever they're paying in real estate taxes, let's say another 15 to 20 grand, because surprisingly real estate taxes are kind of cheap in New York City.
Right.
So now you add these two things together, all of a sudden, you're losing 20K of deductions.
Right.
So the old Trump tax cuts, in that situation, if you're a W-2 earner, all you had was your W-2, you were a high income earner, and you lived in a blue state that had high state income taxes, basically in that particular situation I just gave you of $250,000 of W-2, you were paying an extra $10,000 to $12,000.
Got it.
Okay. That has changed now, where they're now granting up to $40K.
So $30,000 more.
$30,000 more. Say you're in $380,000 of income that you're making. So you're in a 32% tax bracket. We've now increased that cap from $10,000 to $40,000.
Right.
That now puts you at $30,000 of additional income deduction based on that 32% tax bracket, it's like about, what, $11,000 or so of tax savings that you got just right there. Now, some of the things, there's other benefits, but we want to kind of be showing the goods and the bads here, right? So while you are getting that additional 40K, they're capping the bracket at which you can take these deductions. So let's say you're somebody who is in the 37% tax bracket, right? And you're paying self-employment taxes on top of that. So maybe you're paying a little bit more. Maybe you're paying like close to 40% federal income tax, right? You are only able to take up to 35% of your itemized deductions. Doesn't make a huge difference, but it's about 2%, 4% possibly. So you're talking 4% on if you're making $1 million a year, now all of a sudden that's 40 grand. So while you got 12 grand back, you also just lost a decent chunk of that. You're getting a loss about 40, so the net benefit is a little bit less. So there is some additional tax consequences. It's a little more convoluted when you go through the itemized versus standard and taking deductions through an LLC versus if you're on W-2. But generally speaking, you got the SALT, but you also lost a little bit of that maximum deductible amount. The big one that I think is going to be the biggest, wealth transfer savings is not going to be for the people who are earning this money. It's going to be for their children. So lucky them. Not only do they get to inherit a bunch of money from a rich dad or mom, they're also now, the estate tax is doubled to $30 million per couple. So that first $30 million that you receive, there is no estate tax on it. Prior to that, so prior to 2018, that was $11 million per couple. It was 5.5 each. That's a difference of $20 million. The estate tax federally is close to 50%. You're talking about a $10 million savings for anybody who has an estate over $30 million. That's a big one. That's a huge one. So another nice one that comes in, this is for everybody. This was something that came around during COVID and then went away, and I think it was just popular by design, and that is the additional charitable deduction on top, even if you don't itemize. Even if you're not itemizing, it doesn't matter how much money you make, you get an extra 2K if you're married, you get an extra 1K if you're single, and that's just an additional deduction you get to take on top, which, based on your tax bracket, that's, a couple $100 right there.
So you're getting a $1,000 deduction for what purpose?
For your charitable deduction. So even if you're not itemizing your deductions, you're still getting an extra $1,000 to $2,000 if you're married of deductions. So even if you're a standard filer, you get your standard deduction plus another $2,000 on top, which is pretty nice. Clean energy, if you've been following along, that's been a big one. That's all getting phased out. Solar and EV are gonna be gone by the end of this year. So you're looking for solar, which there's a lot of math out there that tells you it's starting to make sense. And there's, when you factor in the big tax credits that are available, it's about 21% of the total expense that you paid. Solar was a very, very lucrative way for people with high incomes to save money on their taxes. That is going to be gone starting next year.
For some of those clients, I would assume there are clients that are out there that are, maybe purchasing an EV for the benefit of getting that tax deduction. They're looking for another car, or maybe a car for a business. There's no real alternative at this point. It's just, it doesn't matter if you get an EV or a gas car. The only savings you're getting are on gas, essentially. If you're just charging your car as opposed to buying gas, that's really the only savings you're getting from an EV.
Correct. Yeah. That $7,000 is no longer available. Some states are still going to have it. But federally, that's out the window. Generally speaking, if you're talking about who's going to be bearing the brunt of the tax bill, it is these folks who are on W-2. Generally speaking, those folks is where a lot of this tax burden is being shifted to, which, everyone has their opinions on it. I personally think that there may be a better way to plan this, maybe some corporations that pay zero taxes. But as it's written, as it's passed, as the bill is going, this is where most of it will shift to. You do get that 12 grand though, so that's nice. But you are going to be paying a higher top tax bracket. You're going to be losing a lot of the credits that are available, which were thin and slim pickings to begin with for people who make over a certain amount of income. And generally speaking, this is the best incentive since the last tax bill to go 1099 if you have the opportunity. That's one side of it. Now, the other side of the bill is just touted very highly. It's, the lower income, the middle income people are going to be saving on their taxes with this new tax bill. I think generally speaking, looking at what the Tax Foundation has come up with, there is very positive outlook on GDP, GNP, things like this increasing. I will say, if you make less than $50,000 a year, you are absolutely saving money on your taxes, for sure.
With this bill.
100%. If you make less than $50,000 a year. Under 50 for sure. Over 500,000, you're paying more for sure. The biggest one, this is huge, is your increase in the standard deduction, which now goes to 32,000 for a married couple, or 31,500. Plus, you're adding on the extra 2,000 of the charitable deductions that you can take up to. So now you're talking 33,500 that comes immediately off your taxable income. So you're somebody who's making 70K, the first half of your income, 35,000 or so, is wiped away, and you don't pay tax on that.
Yeah, that's
so
great.
All those things, and then you pay the graduated tax rates on everything.
The marginal of whatever's left, right?
So that's a good spot. That's a good thing for people who are in, generally less than 100, and certainly if you're less than 50. Then the child tax credit, that was going to expire. That was renewed, and it increased by $500. So now you're $2,200 for the child tax credit.
Instead of 17.
Instead of 17. That's also great for people who are below that 250,000 limit. The federal savers match. So this is an interesting one. It doesn't apply to anyone who's in that $500,000 range, but if you're below that number, so anybody up to 500K, you do get a savers match. Stuff like this scares me a little bit because it leads to, why are you incentivizing this? Because maybe it has to do with Social Security or something getting trimmed down a little bit.
Getting it reduced. And we've had these conversations in the past with clients that the trend of what's going to change in Social Security, right? They slowly start to maximize the RMD amounts, right? It went from 70.5 to 73, 2023 it goes to 75. So there's definitely going to be changes that are made to Social Security. I think they're slowly trying to prepare us for it. And maybe this is one of those things, right? They're putting us in a position to incentivize us to continue to save so we're not as upset when they do make the change.
Agreed.
It just depends on what the change is.
Some of the bigger ones, the things that people really need to be conscientious of. The premium tax credit and how that affects you. If you're somebody who uses government healthcare, if you use the healthcare exchange to pay for your healthcare, some of those premium tax credits are going away and changing. And some of the restrictions and some of the rules surrounding the earned income tax credit, it's going to be tighter. There's going to be more audits.
Right.
It's going to be automated audits that look like are part of this bill with the AI implementation rules.
Yeah.
So unfortunate side of this is it does look like there would be more targets towards lower income people from the IRS, especially people getting some of these tax credits. The third segment here that we really want to focus on is some of the changes to the tax bill. Since 2018, I have been telling people the best thing you can do to save money on your taxes is go 1099 versus W-2. If you can, some of the bonuses and the tax deductions that are available and the credits that are available, it's incredible, and there's a lot of tax savings that can be had there. We want to kind of talk about what's been renewed, talk about what's been gone, and then also spend a lot of time focusing on some of the new things that are available. So just to quickly recap the things that were renewed. QBI, Qualified Business Income Deduction. That is if you get paid through a 1099 or if you have your own business and those businesses are pass-through entities, which are S corporations, partnerships, single member LLCs, any of those entities, 20% of what you make gets removed immediately. You only pay tax on 80% of that income. There's a specified service business.
Right, to determine what qualifies for that QBI and which
Correct. Rule of thumb on that, and look it up if you're unsure if you qualify for this, but rule of thumb on that is if you're selling a product, you're probably qualified for a QBI, whereas if you're selling your skills or your knowledge service, you're probably not.
Right.
So, and that's been there. Now there is a threshold where everybody gets it, and then the service business people kind of get eliminated on. That has increased. That is now $400,000 a year, which is a good chunk of change from your pass-through QBI, right? So if you're an S Corp, keep in mind, you want to make sure that your QBI number that's coming through to you is below that $400,000 number.
Right.
Airbnbs are some of the most powerful tax savings vehicles for the next 5 years. However, not all Airbnbs are good investments. Something we really try to enforce with our clients is making sure that every deal they get into pencils and makes sense. We will have a longer form video coming out soon on how to analyze and get into the right types of short-term rental strategies in order to save money on taxes. But for the time being, we just want to go over some of the things we see more commonly promoted.
The next one's big, right? I mean, the amount of ads that I've seen on companies trying to get you to buy Airbnbs because now you're getting the depreciation.
Yeah, I know.
Yeah, like what are we looking at? Like what?
Yeah, I find this to be like one of the biggest clown moves that's out there, which is, oh, I'm gonna go buy an Airbnb and go become an Airbnb professional in order to
get a deduction.
Yeah, it's like, hey, this works for people who are real estate professionals who know what they're doing.
Right.
And if you want evidence of why this is a clown move, go look at how many Airbnbs are for sale.
Oh
in
yeah, Florida, forget it.
How many people who realized what accelerated depreciation was in like 2020, 2 years after the law had gone into effect, 3 years after it was proposed, and now they're like, well, we can get around all of this by going and buying an Airbnb and classifying it as a short-term rental.
Right.
You don't have to be a real estate professional. You're continuing to work your 9-to-5 job. So you go buy this Airbnb, hoping to go save a bunch of money on taxes. Probably some charlatan on Instagram told you how you're going to pay no taxes if you did this. Maybe, possibly, if you did it the right way, you avoided a bunch of taxes, which is great. You probably got some cost segregation study that lowered your purchase price.
But I mean, I feel like most people, they look at it for the 100% bonus depreciation that they can get, and then no one talks about, depreciation recapture in the event that you said, you know what, I don't actually want to be in this business. I got the deduction, and now 2 years later, I'm trying to sell this thing, and then
or
you
the
sell
fact that Airbnbs generally don't make sense. We have clients that come in that will go and buy a property to go get a tax deduction on it,
right?
And
think
they are
can Airbnb.
barely breaking even on their interest and principal payments, right? Like after you collect your revenue from that month, and after you've made your whatever, you've had the headache clients that you've had to go and change the sheets for and do whatever. Now you've made enough to maybe break even for the month, and people are
and then the next month you got to do it again.
Yeah, well, people are like, oh, well, I'm building equity, I'm doing this, I'm doing that. It's like you're also taking a beating or taking a loss every month, or when somebody doesn't rent your place, now you're spending money on it. And this isn't just me talking bad about Airbnbs or the strategy, or talking bad about certain influencers that push this stuff. It's backed up in the fact that there are people taking beatings on these Airbnbs. People that could not make them profitable. They bought the things, they relisted them. Then not only did you pay back the taxes, because you recaptured all that depreciation you took, but on top of that, you just took a loss for 2 or 3 years. Plus you paid your broker, plus you paid property taxes that were non-deductible.
Well, and you think about, like from a planning perspective, obviously, the numbers look good, right? You look at the numbers, oh, I'm getting depreciation. I don't have the responsibility to pay some of these taxes because I can write it off on some of my other, taxable income. But at the end of the day, the other part of it is, to your point, every month I'm treading water just to be able to break even. And at the end of the year, would you pay $8,000 or $9,000 to not have to deal with that? And I think most clients' answer would be, yeah. I'd pay $9,000 to not deal with this. That means not buying one. And just not.
Or 2 years down the road, it's like, hey, would you pay me $9,000 to not have this headache of a property that's got a $5,000 a month mortgage and more than a renter?
And more than likely, if you're trying to get the deduction, the depreciation deduction, a couple years down the road, your income is probably higher than it was, and now you're recapturing all that depreciation, and you got to try and sell it.
Now that doesn't go to say if you are a person,
a professional who's doing it,
or even if you're somebody who's like, hey, I genuinely want to become a real estate professional. Okay, well, step one in being a real estate professional, your investments should make you money. You find a deal that makes sense. It's not overpriced. You're not paying some crazy premium.
Right.
You're not trying to calculate your break even on an 80% occupancy on a nightly rental place.
Right.
Then sure, go forward with it. Do it. Investing back into yourself should always be done.
Right.
Buying something that you're not sure about or you don't need to save money on taxes is how you set yourself up for disaster. The R&D credit is another big one that came back. R&D credit is basically, there was a change that occurred that allowed you to take the full R&D credit. That went away, and we went back to the old rule, which is if you're developing a program or if you're spending money on something that hasn't been developed yet but is going to be developed for future revenue, you were forced to amortize it over 5 years. Now you can take the expense directly. If you have an idea, if you have a business that's going well and you say, hey, you want to help me even more, getting a better web presence. And I want to build a brand new website, and I want to spend a bunch of money on an app that people can use to, find my product easier. Go for it, because now you get a full deduction. You don't have to take the
research and development of everything you're doing.
Yeah. And once again, this is another thing where hopefully, you're expensing everything, but your revenue should go up. They're gonna have more taxes, which is fine. You made more money. So these are things where you're spending money to increase future revenues. And that's the way that I think the tax law should be written.
I'm seeing a common common theme here, right? The more you put into your own business, the more deductions you get, the more your business actually inevitably grows.
And then the more
doing
taxes
that-
you have to pay.
Right. More
Theoretically, until you get so big that you don't have to pay taxes anymore. because of
Yeah.
Amazon.
Well, that's everybody's goal, right? Is to get to the point where you're in the ultra net worth, and then you're really upset when people are trying to get you to pay taxes.
Yep. Then the business income loss limitation, right?
Okay.
I think this is an important one to touch on. This started in 2024 and probably upended a lot of people's tax planning, especially people that listen to some of these tax gurus who have zero licenses or credentials.
Right.
The business income loss limitation was put in place so that people couldn't go and buy 20 different Airbnbs and take a bunch of losses and offset their income. Each individual business can only lose so much money. So if you were to buy one piece of property that's like a $5 million warehouse, right? You put $1 million down, you do a $4 million mortgage on it. Warehouses, part of the brand new tax bill, which is not something people have been talking about, are subject to a full 100% depreciation. This is my initial reading of it. It says that all aspects of a factory or a warehouse qualify for a 20-year life, which means that you should be able to deduct the entire building.
Right.
In those scenarios, even if you took a $4 million loss on that warehouse,
Right.
you would not be able to use all of it. And it doesn't carry over based upon the loss limitation.
You wouldn't be able to.
No. So you may not want to do a full accelerated depreciation. You may want to do catch-up depreciations every couple of years. You break down the building, you accelerate depreciate parts of it, other parts of it standard depreciation, then you file a catch-up depreciation report in future years to make up for those losses you couldn't take.
Right.
So strategy, thinking, knowing what you're doing, all these things kind of factor in and, not just rushing into a plan. So that's the stuff that that we all know about, like
Right.
things that are out there. I think, we did go into some detail and talk about things that maybe some people don't know about, but that information's out there. This is like the newer stuff that when the last tax bill came out, I didn't see people talking about some of these types of things for like 2+ years after it came out.
Right.
So this is stuff that's
let's get ahead of it now.
And let's try to get ahead of it.
This is the new stuff of the big bill. May or may not be beautiful depending on who we're talking to.
Yeah, exactly.
Okay.
All right, so you got the small biz workforce credit.
Okay.
I think that one's really cool.
Let's talk about that.
You have less than 25 employees and you're gonna hire a new person. You're gonna hire this person for at least 6 months and you're gonna pay them at least $25,000. You get $3,000 back from the government for hiring that person. Up until you hit that 25 employee limit. That's
On each employee?
Per employee, $3,000.
So you can hire brand new business, you hire 25 employees, right? You're getting 35,000 per, 35,000 off. Wait.
I think your math's wrong.
No, 65,000.
65,000, yeah.
65,000.
No, 75,000. No. 75,000.
It was
75,000, yeah.
15 and 3, yeah, 75,000.
Anyone after that, there's other things that are out there.
Right.
But this small business workforce goes away. Then the PFMLA, the Paid Family and Medical Leave Act. It's a permanent policy now where you as the owner, if you're offering this to your employees, you get up to 25% of the wages you pay the employee while they're on family leave. You have a really good employee who's pregnant and having a baby and you give her maternity leave. You're now incentivized by the government to do it because they're going to, not only are you going to want to keep your employee and give her maternity leave hopefully anyway, but now the government's going to give you 25% of what you paid her on top. Another big one, Section 179 for energy efficiency. So while some of these energy efficiency credits went away, there was a big thing that we did a push for last year with a lot of our clients that qualified for it. At the bare minimum, we were educating people that may or may not have taken it. This had to do with the $2.50 per square foot of your space, of rental space or warehouse space or whatever you have. If you put into your business energy efficient HVAC and lighting. And if you're in an economically disadvantaged location and you use apprentice rates, prevailing apprentice rates, which are all listed online, you get an extra, at the time it was a 2x boost. So you get $5 a square foot for changing your light bulbs.
Wow, to energy efficient compared to whatever it was before.
So that's another nice one. And then the startup R&D payroll. This is a new one where, well, I guess it's not new, but they've enhanced it.
Okay.
Where it's now doubled on the cap. You get basically $500,000 a year in R&D credits. R&D credits is a whole other topic, and I'm actually, we want to bring in another CPA that we've worked with on this. We actually have started a relationship where we're outsourcing a lot of our R&D work on this because it's so in depth and there's such like a deep value that can be gained from that there are people who are specifically trained just to do R&D tax credits beyond just like R&D on like developing a program or doing some tech, which is also available if you do this. This has to do with the payroll, right? So if you are a startup company, meaning less than 5 years, and you make less than $5 million in gross receipts, you can hire W-2 employees to do R&D work for you. So who this applies to is more like tech companies.
Right.
You can get
Engineers,
up to 500 engineers, right? So you're getting up to $500,000 from the government in direct tax credits.
Wow.
On these employees that you're hiring. And that used to be a 250K cap, now you're at 500,000. So this is, there's a lot of interesting things here with how to structure some of these purchases, right? And navigating this. So to me, probably the thing that sticks out the most is, hey, if you want a project for this year to get tax savings, solar panels seems to be the way to go.
Yeah.
Right? You get the solar panel tax credit right now. On top of that, you get the accelerated depreciation, the reset of the bonus depreciation, and next year, the credit for the solar is gone. So that's probably a good project to look at for this year, right, and how to structure your tax situation around. And that can be applied both at the personal level as well as the business level. That to me is like probably one of the key points that I would look at if I was somebody that's trying to plan around my tax scenario for this year.
So what are some other tax credits that, maybe might be beneficial for some people?
So kind of touching back upon the hiring credit,
yeah,
there's an additional work opportunity tax credit. A lot of this has been state by state level. This is a federal one. It looks like it's been extended for the rest of this year. Okay, most likely will get renewed for next year.
So it's not in place yet?
It's extended for this year. So it's in place-ish,
right,
but there's going to be some reworks to it, which is going to increase the amount you can take. This has to do with hiring people. I'll tell you the exact list here. Veterans, long-term unemployed people who basically, I think they
haven't had a job for a long period of time.
Disgruntled workers, right, ex-felons, and SNAP recipients. So if you're any one of these, which SNAP obviously is coming off,
right,
so that's going to be a great place for, if you're a business owner, just places to be looking when you're hiring folks.
Yeah.
Especially if, they fit the criteria of what you're looking for in an employee.
Right.
Not only are you going to get the, an employee probably hopefully at that's going to help you grow your business, but you're also going to be getting between $2,400 and $9,600 per employee that you hire that meets one of those criteria. So while you're doing your search, while you're growing, hopefully the expectation is there should be growth in the economy with this bill.
Right.
So while these businesses are growing because of these tax cuts, look for people that meet these criteria so that you can get an additional benefit for yourself, as well as hopefully hiring people that are, in need of work.
Sure.
The disabled access credit, which is something that the ADA credit that a lot of people take. So a lot of medical professionals will take this credit. If you offer things that allow people that are disabled to access your business.
So like adding a ramp to your ice cream shop.
Yeah, I mean, there's like a whole list of laws you have to follow anyway.
Okay.
These are the ADA laws.
Right.
You have to make it accessible, otherwise you can get sued.
Right.
And there are specific lawyers who are like the scum of the earth.
Specific to that.
Who try and find those companies trying to like sue people for this.
Right.
So you can get up to 50% of what you spend as a credit.
Okay.
Right? Not as a deduction, as a credit. And now there's a couple things that fit into this to make you a small business that hits this.
Right.
Less than $1 million of revenue or gross receipts, less than 30 full-time employees. And if you're spending this money to get people to be able to access your property, whether that's a ramp, redoing your stairs. There's a lot of things that you can do to make your place handicap accessible. And then this one is, I think, one of the cooler ones. I still don't know exactly how this works because it's still a little murky based on the way it's written, but you can take, as an employer, up to 25% of the costs for childcare for your employees. So if you are offering on-premises daycare, or say you're a single member LLC and you're the only employee of your company,
right,
and you have to get daycare because you
can't take care of your kid at work at the same time, right?
So in this case, you get 25% back as a deduction for your business. Well, you already get the deduction for the business as an expense, but now you get a credit on top of that of 25% of what you're spending. It is not available right now. It's not a law right now, but it's written in so that it's supposed to turn on. definitely stay ahead of that one because that can be, that childcare is expensive.
Yeah, of course.
You get 25% back as a tax credit. That's massive.
Yeah, I mean, you're talking some families are $1,000 a month, let alone maybe sometimes a week, depending on how many kids they have. You're getting 25% of that.
Yep, as a credit.
Yeah, that's great.
This one is a little, so this has to do with, once again, where people maybe have some criticisms of the one big beautiful bill. So while the clean vehicle credit is going away for individuals, businesses are going to be able to get up to $40,000 per vehicle in tax credits.
If it's a EV.
If it's an EV.
Wow.
So
individual families aren't getting the benefit of getting an EV, but if the businesses get an EV, they're getting a pretty substantial.
So you can write off the entire car immediately, and on top of that, you can get
this credit up to $40,000 if you buy the car through the business. Start that one.
While things have changed from the previous bill to the current bill, most of it's the same. You should still continue conducting your business in the same way you would normally conduct your business. There are some nice little caveats and perks that are coming in. A lot of them are going to be around for a long period of time. The only ones that you're going to miss out on if you don't take advantage of is probably this solar planning. But, generally speaking, talk to your CPAs, talk to your financial advisors, make sure that they know what your situation is and what you're trying to spend money on and how you're trying to grow your business and live your life personally so that they're using this information that's in here to tailor it towards you. And we'll see you at the next video.
Yeah, thanks for joining us, and hopefully some of this information was helpful. Thanks.